Good morning and welcome back. Today, another conversation on a subject which I find personally fascinating. And I would like to share with you my thoughts about it with the intention of the hope that these thoughts could help you maybe in getting a different understanding or some understanding of certain things related to investing. Obviously, this is not financial advice. It's not an invitation to buy or sell anything. It's for educational purposes only. I present my own opinions. I don't expect them to be factually correct. It's just what I think. Purely an opinion, not an advice, education purposes only. We did it again. We succeeded to get this stuff out of the way. So, today I would like to spend a few words about um, one of those famous say that everybody repeats on a daily basis, and a lot of time is spent in trying to get these sayings meaningful in some way. And one of the most famous ones in investing is buy low, sell high. Now, as you certainly noticed in this slide, I already gave you a bit the answer to this question. Does it make any sense to talk about a high or a low when we talk about share prices? And the answer is not really, because buy and low are absolute terms. Um, sorry, high and low are absolute terms. There is no way to define what high and low actually means. You could argue that a share price of 0 is low because it cannot go lower than that. But what is the high? There is no way to measure it properly. And yet, the financial industry, investors, banks, analysts, rating agencies, governments, are spending an incredible amount of time, energy, and discussions to define what high and low actually means. And that has to do with the valuation of companies. It's a whole sport that is getting played, and it moves an enormous amount of money. Valuation of companies. So there are different ways people tried in the past to decide if a share price is meaningful versus the value of the company. You know that you buy companies by buying shares. So when you buy a share, you actually buy a company, right? What is the worth of that company? And is the price I pay for that share making any sense versus the value of that company? That's a very, very much asked question by everybody all the times. Famous investors, Warren Buffett in particular, devised his own system, discounted cash flow. There are older systems, like for instance the price-earning ratio, the PE ratio, which are quite famous. Almost every investor knows about it. Earning per share is another valuation system, really. And there are a number of other ratios, so-called, like the PE ratio, which are used by a lot of people to decide if the price of a certain share related to a certain company is meaningful or not. These discussions are incredible. I mean, literally a lot of time is spent in identifying if a company is priced correctly, it is overpriced, or it is underpriced, with the idea to identify the low. So the price is low when the valuation method that I just described, one of the many valuation methods, is telling investors that the price is low. Conversely, the price is high when these valuation methods are saying that the price is excessive versus what the value of the company is supposed to be. Great. But you know what? From empiric observations, and I've been in this business for many, many years, the correlation between the fact that a share price is high or low and the way the share price is actually moving is very close to zero. So, give you an example. Suppose you buy a company that trades at 10 euro per share, and everybody agrees that 10 euro a share is a low price because the valuation method of the company tells them that the price could be very well 20, 25, 30, and therefore the share price is cheap. It's a cheap company. You can buy it for cheap. Okay, that's fine. So you would expect that if you buy these shares for 10, within a year time, 6 month time, you will see the share price going up, right? It is a fair expectation. It is underpriced. It is for sale, so-called. So the share price should go up, right? Well, guess what? This is true kind of 50% of the time in my observations. And why is that? Or how do I see that? Well, because as an investor, I have a relatively large amount of companies in my portfolio, so I can see many companies' share price changing every second, by the way. But when I see the price change across a certain amount of time, which runs in the weeks and months, I very often find out that and I'm a specialist in the so-called value stocks. So value stocks are supposed to be cheap, right? And I see that a lot of times these so-called cheap stocks are not only not moving very much in price, they are not, specifically they are not going up in price, but they oftentimes go down in price and not a little bit too. And I got accustomed to the fact that when I buy a company that is supposed to be value, which is supposed to be cheap in terms of share price, there is no guarantee whatsoever that the share price will do what the low price suggests. Conversely, and this is also something I noticed too many times, I guess, there are companies out there which are on paper completely crazily overvalued, okay? And the price of the share in relation to the value of the company is out of comprehension. For those who would like to have some technical terms, I know companies that are trading for hundreds PE, and people keep buying them. People keep selling companies that are supposed to be cheap, and people keep buying companies that are supposed to be crazy expensive. Now, this is the theory, right? These are observations that I made. What does it mean for me as an investor, as a trader? To me, it means that I cannot really rely on these valuation methods to decide if I want to buy a company or not, because the correlation is too weak. Cheap companies remain cheap companies, sometimes become even cheaper, right? So I cannot really say, when I have to decide if I want to buy a company or not, go into any of these evaluation methods and have any certainty that what I'm buying will appreciate in the future. I don't know, and these evaluation methods are not effective in informing me of anything. The proof of the pudding is in the fact that, in theory, if these evaluation methods were actually working, at least most of the time, not always, but most of the times, one would expect to see a regular recycling. Cheap companies become more expensive companies, and expensive companies return to be cheap companies. So you would expect to see something that qualifies as a low price or a high price. There is nothing like this. In my observation and in my opinion, to talk about a low price and a high price and a high price in these terms is meaningless. A much more interesting approach, at least for me, has always been to talk about lower and higher. That helps me a lot. When I compare the price of something to something else, I can get a view whether the price I'm looking at is meaningful compared to other things. Suppose you are going to the supermarket, okay? It's very simple. You are looking for olive oil, and you have 5 brands. All the brands sell olive oil in 1 liter bottles, right? They are all advertising that they are olive oil with the same quality, same kind, right? And you have a price range between €2 per liter and €15 per liter. Which olive oil are you going to choose? The most expensive one, because it has a nicer bottle, it has a name, it has a brand, it has whatever you think is of value. You go ahead and you buy that. That's your evaluation of that bottle of olive oil versus the others. So when I look at share prices for companies, I compare those companies to others which are in the same sector on one side, and on the other side I ask myself, whatever the share price is, do I want to buy that company? And if I want to buy that company, why do I want to buy that company, that specific company? So let's start from the second one. Suppose I'm interested in buying a company in a certain sector, okay? Do technology, just to mention one. I want to buy a company in technology. I want to have a company that makes money. I want a company that doesn't have too much debt. I want to have a company which has a cash flow. And I want a company that pays dividends. These are the 5 criteria that represent value to me, right? I identify 1, 2, maybe 3 companies that are fitting these criteria. When I look at the share price of these companies, and I look at their financial data, I figure out that these companies are comparable, but one of them pays the highest level of dividends compared to the other 2. Since dividends are representing value for me, I end up choosing the company that is paying the most dividends. It's the same approach I would use when I buy a bottle of olive oil. If the olive oil is of the same quality, and I don't care how the bottle looks like, and I don't care if it is branded or not, I will probably go for the cheaper. Notice, I said cheaper, not cheap. Cheaper than the other. And if you apply this to whatever kind of investing you intend to do, instead of spending a lot of time listening to incredible conversations about evaluation models and so on, I would start personally by asking the same question I ask myself every day. Do you want to have that company? And why? What are you going to use this company for? You're going to use this company to make money in a way or in another. Dividends is one way, but also trading the company, selling and buying it. So when people when people talks about buy low, I read it in different terms. I read it in terms of buy the company you like for reasons that you can explain to a 10 years old in 30 seconds, as I do, for a price you can pay, with a clear intention to sell this company for a higher price in the future. Buy what you like at a price that makes sense to you and sell it higher. You don't buy necessarily low, because there is no low. You buy a company that you like. You sell it higher, and you make money in the process. Evaluating the company is an interesting intellectual exercise, and it has some value in my opinion, because it helps to get a feel of what other people think this company should be worth. But when you apply this thinking and these opinions of people to what will happen to the price of the company you buy, you didn't know before, and you don't know later. You don't know what happens to the price of that company. Can go up by 20% tomorrow for no reasons whatsoever. Can go down by 20% tomorrow for no reason whatsoever. And that's the reality of trading, you know. So the buy low, sell high is actually one of the many ways where investors or traders complicate their life incredibly much. It's the same discussion, similar discussion to what to the one I had with you a few days ago, when I was talking about the good company. What is a good company? The good company, or the good investing, or the best trading chances, are not depending on metrics that people use, are not depending on anything else than what you think is right. Now, having said that, and I repeat myself here, there are a few things that I think every investor should be very concerned about. And that is avoiding buying lemons. So it's not a question of buying good companies as such. It's more a question of not buying bad companies, companies that are going bankrupt. Because if you buy a company that is going to go bankrupt, you will lose all your money, all the money you invested in that company, right? So I see all these metrics and all these evaluations and all these kind of things as a kind of filter. Everything that sticks in the filter are companies I shouldn't buy anyway. And everything that passes through that filter are companies that are potentially interesting, depending on circumstances, depending on how much they cost per share. Do I have the money, right? Depends on if I understand what they are doing. Very important. Should I buy something I don't understand what they are doing? Not for me. If you want to buy something that you don't really care to know what the company is doing, be my guest. But for me, personally, that represents a very bad idea. But once I understand what the company is doing, once I have a bit of a feeling that the company is not on the edge of being bankrupt, it pays dividend, it's a valid company. It's just, for me, it's just a money machine. I buy a money machine. You know, as a shareholder and co-owner of that company, my expectation is to see the profits generated by the company shared with me as a shareholder and a co-owner of that company somewhere in the future. By dividends, by being able to sell that company for a better price in the future, it doesn't matter. That's the thing. I buy money machines. and I sell money machines. And that's what, for me, trading represents and investing represents. I do not buy something that is broken with the hope that one day will be fixed. I will buy it after it is fixed. I might have to pay a higher price than before, but I won't buy something that doesn't generate what I wanted to generate. So a bit of some ideas about the subject I really care for, and also one of the main reasons why I'm sharing these views with you is that if you follow the discussions that are on newspapers, on the media in general, on forums, all the folks out there who are still using charts, I'm sorry, but that belongs to this discussion somehow. I will tell you about it another time, but the amount of time and indecision that this buy low, sell high, and other stuff that is around the stock market, and the amount of confusion it creates, especially for beginning investors, but also for experienced investors, is unbelievable. A lot of opportunities are lost just because people get completely excited or depressed about the fact that a company becomes too expensive. Most of the time, too expensive means absolutely nothing. Very cheap doesn't mean absolutely nothing. The fact that a company is very cheap will not cause the share price to increase in any foreseeable future. There is no relation between the evaluation of a company and the way their share price will move in a relatively short time, say weeks or months. Okay? So, just a few ideas. I hope they can be useful, and we will talk again next time. I have a list of things I would like to talk about with you, and if you find this useful, please let me know. And if you are interested to know when a new video comes up, subscribe. And I wish you a fantastic day. Thank you. Bye now.